All right, we are back with another edition of the Sunday Scary Stock Talk podcast. I am joined with a special guest, my good friend John Lightsey, who is a friend of mine in the Tampa Bay area. So, John, why don't you tell me about yourself?
Right. So, John Lightsey. I was born in Orlando, but raised in the Tampa area. I actually went to Armwood High School, which is over kind of in the Brandon Sefner area. Um, After I, kind of went through high school in Tampa, I used to weigh about 300 pounds or so. So I was lucky enough and blessed enough to play Division I football up in Mercer University, play offensive line, and then after about 2 knee surgeries, I realized football was not my profession or my future. So I went pro in something other than sports, which was accounting, and I decided to come back home to Orlando to go to UCF to get my master's degree.
Nice, nice. So, tell me a little bit about your work experience. I know you're not just right out of college; you're an older guy like me.
Seasoned is what's said in the profession. But no, so when I was in my master's program at UCF, I actually had a professor who asked the entire class of about 100 what we wanted to do with our future and where we wanted to see ourselves go professionally. And he asked us if we wanted to stay in Orlando or travel abroad or go to one of the financial hubs of Chicago, New York, Boston, or even out in California where the tech hub is. And that kind of sat with me for a good bit. And after a few things happened, I saw a few signs from God kind of led me to go up to New York City, where I practiced auditing and consulting for about 3 years. And then, as everyone's aware, COVID hit. And so that kind of shut New York City down. And after that, I decided I needed to kind of come back home and spend more time with family. And that's when I kind of pivoted from the more auditing and consulting vibe to more so of operational support with finances. So currently, that's where I sit now, is just doing operational financial support.
Nice. So yeah, so you recently went under, a new interview process and you got a new job to my understanding, kind of during this time that they're deeming the great resignation because a lot of people are not really being, I guess, super loyal to jobs or, they got fired during the COVID crisis and they're kind of bouncing around until they find a new quote unquote work home. So what was it like going through the job interview process? Did you do anything like specifically to make yourself stand out? And yeah, just do you think that that interview process was any different from when you first got your original job?
So I think when you have your first original job, right, employers understand that you're fresh out of college. You're not always going to say the right thing. You're not going to really know per se what you're talking about. When it comes to when I got my first job out of my master's program, it was more so focusing on your work ethic and focusing that you're a team player, which I still think that you need to portray in any type of interview. But I'd say the first thing that to start with any interview is, showing up on time. My college coach always had a saying, 5 minutes early is on time and on time is late. So typically, especially now with all these Zoom calls and Microsoft Team calls that go on, you should be the first person logged on and waiting in the lobby. Otherwise, if you're late to the interview, that immediately writes you off. At least in my opinion, when we're hiring at my current job, if you're late or even if you're even if it's 1 minute, it still kind of just shows that you don't respect my time. So why should I respect yours? Um, and then another thing is, you're going to get a lot of technical questions at this stage in your career. When you're fresh out of college, they know you don't really know a lot. They may ask you a basic question like, how do you balance a balance sheet, or, you know, explain to me, the flow of a P&L. But at my stage, they started asking you very in-depth questions. I remember my most recent job, they asked me to pretty much backtrack um, net income to free cash flow, which is not something that you would typically ask a person fresh out of college. Um, and so I think the standard is higher when you're at my level. So again, hammering, your work ethic and ability to pick up items on the fly stays consistent from then and now. And then I would say stressing your proactivity compared to your reactivity. Employers want someone who's not going to wait around and just wait to be told. I mean, that's typically what an employee is, but if you really want to progress in your career, I think being proactive is very key. And so I think that's kind of what set me apart from the rest of the candidates, especially in my newest job was, I very much stress that I'm a team player. Work ethic is strong. And then I know a lot of people today stress the work from home culture, but if you're trying to find a new job, I understand that you need to find some things that kind of tailor to your needs. But I think overall that, you need to kind of be flexible with your new job. And, some employers still want you to come in 5 days a week. I'm currently going in 5 days a week. Some employers only want, half work from home, half in office, and then some are completely remote. So I think it's all about setting expectations too with your potentially future employer. Um, but yeah, I'd say that those are key. And then when it comes to items you shouldn't bring up, especially on the first one, I had pretty much a list from day one because lucky enough, I had mentors who stressed what not to bring up during, especially the first interviews. Things like pay, PTO, work-life balance. I know you want to find something that works with your work-life balance, but if you start off the rip with mentioning that you want to work from home, guess what? You're not really in a negotiative state. I know it's the great resignation, but you're still applying for a job. And if you start off the rip with that, it kind of sets the tone that you focus more on, you know, kind of your preferences rather than the team's preference. And then also, I recommend not to, bring up any negative aspects of your current slash former employer, because if you're talking bad about them in that current moment, the person who's interviewing is going to pretty much say, well, wow, what are they going to say about us if, hypothetically they were to leave? It's just not, I think it's just not a good look. Um, but other than that, I mean, I think it's just all about being, just truthful in what you want and kind of matching and aligning those, expectations.
Yeah, I think I'm kind of in the similar same boat. I recently started a new job about 3 months ago, and I think what helped me was almost like putting myself in a position to stand out. So that my company had like an open house, so I would recommend for anybody to just kind of look at places you want to work, and if you can reach out to somebody, find a mutual connection, that always helps too. And I think now too, a lot of these companies are doing a lot more interviews. My last job, I went through, I think, 4 separate interviews, and they were saying that, that was above the industry standard and everything like that. And at this current job that I'm at, I had 5, although they were a lot shorter and everything like that. It was still, a long interview process. So yeah, I mean, did you notice anything like that? Did you go through multiple interviews for your one as well?
Yeah. So for my current role, I had three, well, I'd say three and a half. I considered the last one kind of a half interview. The first one was with my current VP. The second one was then kind of implementing the current team members with the VP. So that way it's kind of get a team sense. And then the last one is a panel interview that I had to deal with from different senior leadership. So in my interview, I believe I had the head of marketing, the head of accounting, the VP of finance, and then I want to say it was the head of corporate development. Sorry. So that way they can kind of gauge, okay, is this guy a team player and can he work in all facets of the business? Because although you may, get a job in, recruiting or finance or accounting or, data integration, ultimately you're going to have to work with other department heads, because it is a business as a whole. It does not just focus on one work stream. So yeah, I'd say that. And then the last one was just like the last kind of, meeting to discuss expectations going forward, which I think that is the moment in an interview where you kind of need to set your terms. For instance, in mine, I told the VP, I was like, hey, he told me, yeah, you pretty much have the job. And I told him, well, hey, I have, these family vacations already booked from my current, my current role. Are we going to maintain this? Or, hey, I like to work from home on Wednesdays because I'm not in this instance because I don't have kids, but my kids get off early on Wednesdays. It's their early day. I want to go spend time with them. I think that's the moment and time in an interview where you should kind of set your terms and establish those kind of barriers with your employer.
Gotcha. All right. So you, you don't have to dive into necessarily the exact industry or anything like that, but I know you work with a lot of people in the trades. So what is it like to work with a lot of people that are in the trades? Because a lot of people our age now are getting into more of the, like you said, the techie jobs, or maybe they're looking for a work from home. Whereas, I think the trades are going to be here to stay, and they're going to be needed now more than ever, just because so many people, it seems like, are kind of gravitating towards that. So, what is it like? I know you're more on the, accounting side, but what is it like working with a bunch of people in the trades?
Right. So I do work in the finance department and accounting department. However, our company very much stresses to do a ride along with a member in the trades that we support. It just opens your eyes to a different perspective. And on my ride along, it was just eye opening to what these guys and girls deal with on a daily basis. And I think what was even more impressive was the fact that a lot of these people who are in the trades, they didn't have a college background. A lot of them are former military, or just high school dropouts that didn't really know what they were doing. They were lost. Our society, kind of pushes up that you need to be, in finance, or in tech, or law, or what, the kind of the sexy jobs per se. Where, I mean, if I told people, hey, how would it feel if you could only go to 2 years of school debt free and come out making six figures without even saying what the job entails? A lot of people would say, oh, that's money. Why wouldn't I take that? But that is the trades. I think the lowest amount one of our individuals make is probably in the 80 to 90K range, which is still great money, especially the fact that you don't have a college degree, and you don't really have any other options. You go to trade school for 2 years. A lot of times these companies will pay for your trade school because there is such a need for the trades. And ultimately, if you want to come out of that position and become a manager, or a GM, you can. I've seen it in my specific company. Most of our GMs are former tradespeople who have been in the industry for 20 to 30 years, and they realize, hey, I know these trades inside and out. I can run a business. I know what these people like, what they don't like, what works, what doesn't work. And so I think that's one thing that our society really hasn't stressed. And ultimately, I think that, yeah, a lot of people consider the trades are quote unquote dying, but I think eventually our society is going to meet kind of a convergence point where they are going to be the profession of choice. I mean, you pretty much make your hours. You ride around in a truck all day by yourself, so you don't really have to interact with a lot of people. And again, I think it's something that our society doesn't really focus on, but I think there needs to be a refocus on plumbing, electrical work, and HVAC install, because those are some of the hardest working people I've seen, and they are the definition of making something out of nothing. Because I've ridden along with these people, and they're the hardest workers I've ever seen. So yeah, I think that's kind of my viewpoint on the trades.
Yeah, I mean, I agree with you 100%. So, I mean, just anecdotally from my, my rental property, I have like a little area where I had, concrete, and I needed a plumber to kind of come out and bust it up. And so, while he was busting it up, I was cleaning it up, and just kind of talking with him, chatting with him. And he was like, yeah, I was kind of, similar to your story. I was lost. I didn't really know. So I just, I knew I had a good work ethic. If I, could see something that could come to fruition from it. So if he was making money, he would do it. And so yeah, he just told me about how, kind of similar. He had a mentor, and he just learned everything that he could do. And then, now he has his own business, and he has some of his own rental properties and everything now too. And it's like, no college degree to that. And he's probably making more money than me. And it sounds like, the lowest paying job there is making more money than people that I know that have college degrees. So
Right.
um, I think it's interesting. I think too, you're kind of right on there. It's like we're getting to the point where we're almost at a tipping point where people in general don't want to work. For whether it causes some sort of inconvenience, whether they have to go into the office or something, because I've kind of had it good for these past couple of years. But We're even seeing big companies like Google start to force people to come back in, because people are realizing like at home they're not really putting in as much work as they were before. So, yeah, I agree with you there. I think the trades are going to start to come back, and I think that there's always going to be a place for them. So, whether or not that's something for whoever's listening, it's definitely going to be something that's going to be there forever, because we're going to be needing to build a lot more homes, especially with this housing crisis that we got going on.
Right. I mean, and what a lot of people don't realize either is that a lot of these businesses are mom and pop shops that, run probably a 10 to 15% EBITDA margin, which, for any of the viewers, I mean, that's phenomenal. I mean, if you run a 10% EBITDA margin, let's say you make $1 million off of revenue, and I mean, you're racking in 100K a month, that's, what is that, 1.2 million a year? I mean,
Yeah,
that's just absurd. So,
not too
yeah, no,
shabby.
yeah, it's a great profession if college wasn't your thing. So
Yeah. All right. Well, now let's get into a little bit about inflation and how you're kind of seeing this affect these mom and pop shops. Because I think as far as everything goes, I think inflation kind of affects the middle to lower class more drastically than the rich, of course, because the rich have a bunch of investable assets and et cetera, et cetera. And we actually had the inflation print today getting released as we're recording this on the 12th, of 8.5% year over year for the month of March. So of course, as my listeners probably know, I don't believe fully that the inflation print is justified, and that the 8.5% is accurate. But it's the highest inflation that we've reported, I think, since like the early 70s. So, how have you seen it kind of affect the businesses that you're interacting with?
right. So professionally speaking, I mean, inflation is impacting everyone. I don't care if you're, rich or poor, whatever the case may be. I mean, inflation is impacting everyone. I know, like, kind of like what you pointed on, the low and middle class always gets hit the worst because a lot of those people don't have investments. A lot of them, just in general, I mean, you're paying higher prices for goods and services. So ultimately, unless you're owner of the goods and services, you're getting hit. Case in point, I mean, our materials costs, for the most part, is going up pretty high just because of inflation. Luckily for our business, we're recession proof and somewhat inflation proof because of the fact that we've developed relationships with these suppliers where if there is an increase due to inflation, we don't get hit as hard. But that's a different contractual agreement. One area that I've seen a massive hit also is just the gas prices that have risen. I know that's impacted as well by the Ukraine Russia crisis, but I mean even before that, I mean gas was rising. So I think what it does is obviously it stretches businesses very thin because your your incremental cost is going up, right? Like it's typically your indirect cost that is taking a hit, and it's not really your direct labor, your direct materials, direct cost of goods sold, because usually that goes hand in hand with revenue. One way to combat that though is obviously rising prices, which if we raise our prices, then obviously our consumer feels it. So I think it's just a nonstop cyclical process that once one company raises their prices, we in turn raise ours, and then ultimately the consumer is the one who gets hit. And like you said, I mean, we haven't seen anything like this since the 70s/80s. It's unprecedented, and it's not due to one set administration. Typically inflation takes over years and years of just fiscal and monetary policy. So it'll be interesting to see what the Fed does to kind of combat this. I know they're talking about raising interest rates, but I think that's just kind of a band-aid approach. And I think, it's going to be an interesting couple of months coming up. So we'll see.
Yeah, I have a decent amount of macro guys come on here, and it's interesting to hear like a lot of different theories. So I've had one that's come in that believes that they're going to raise rates three times total, so they've already raised them once. I've had others that think they're kind of going to stay to their word and raise it to 1.9% by the end of the year. Um, but I've also seen some other things like floating around about inflation stimulus checks being tossed around too. So I don't know. I mean, it'll be interesting to see the Fed's response, and to at this point, I'm not really sure like anybody can really predict how they're going to react because everything that they've kind of gone through has just been almost unpredictable, whether it's printing money or something like that. So, um,
Right. And I think, I mean, to your point too, kind of what you said about the inflation stimulus checks. I mean, I know a lot of people think that's like the greatest idea of sending all of these, payments and all that. And I get the theory behind it. But ultimately speaking, the long-term effect of increasing the money supply, especially during, times of inflation, it's kind of like what I said. It's a band-aid approach. It's not a fix. It's like, having a leaky pipe and just slapping on a little bit of putty to fix it. That's not going to fix the infrastructure. You need to completely redo the piping system. So, um, yeah, again, it'll be an interesting, year and a half to see what happens, but who knows?
yeah, definitely. So yeah, you kind of touched on a little bit of from like a business standpoint, kind of pointing to the cost going to directly to the consumer, which I think a lot of times when businesses feel these inflation, whether it's gas prices, or material costs or anything like that, it always gets passed down in the consumer one way, shape, or form. So both of us are consumers in one way, whether it's groceries or anything like that. So, what are some ways that you're kind of looking at to, I guess, combat inflation on your own? Have you changed any habits or anything like that?
Yeah, so I think my habits ultimately stem from the 2008 financial crisis. Um, my father was in real estate development, which was heavily impacted during that time. And so my family didn't make a single dollar for probably 3 to 4 years. So my dad's always been economically fiscal. He got that from his grandfather. So um, I think that I've kind of always been equipped to this. It's not so I'm making a drastic change. I know a lot of people beforehand were spending boatloads of money and just going on these shopping sprees and going on these nice lavish vacations. And um, ultimately, I think it comes down to spending within your means. If you know you want to save up for a trip, well, guess what? You can't go out to dinner every night. So I think the ways that I've changed my viewpoint is typically speaking, Monday through Friday, I try and, stay pretty lean. I cook from home. I try not to go out to lunch every day like a lot of my coworkers do. I don't go on these like massive shopping sprees. I only kind of buy with what's in my means. So if I need a new pair of jeans, I'll go buy one, but I'm not going to go buy 4 pairs of jeans. And then when it comes to, vacations or very extravagant expenses, if I know it's coming, within the next year, I set aside a portion of my paycheck to kind of budget for that. So that way, by the time that expense arises, I'm not like frazzled or scared or just trying to figure out like, okay, where am I going to pull all this money from? I've been saving the past 6 5 months to be prepared for this. So I think one way people can do that is again eating at home. It's the easiest way to save money. What people don't realize is if you buy lunch every day, right? $12, let's say $10 a day for 30 days, right? $300 right there that you could save each month. That if you save up for 5 months, that's $1,500. Guess what? That's a flight anywhere, to Europe. So it's just kind of one of those things where you have to kind of put a monetary viewpoint on it. And again, it all stems back to kind of spending within your means. I know there's a lot of people, especially in Tampa, who try to keep up with the Joneses and try and buy the newest and greatest thing and always trying to stay relevant with what they have and what they've purchased. And luckily my dad and mom always instilled in me that that stuff kind of doesn't matter. And if it came down to the end of the day, if if you looked at their personal balance sheet and you stopped the clock, they'd probably be in the red. So I'd say that's pretty much how I approach my personal expenses. I don't know about you.
Yeah, I think I view them very similarly to you, and I think we're kind of exceptions to the rule. I think a lot of Americans have massive credit card debt, and it's unfortunate, especially during this time where things are getting more expensive, and then that debt's just going to keep piling up. And although the government keeps halting student loans, I know many friends and family members that have massive student loan debt and things like that. So, it's just kind of a cycle that I think if, this inflationary time comes, like more people are kind of waking up to the fact that, hey, although the money printing and the stimulus checks, maybe they don't understand like, the full reason why it's happening, but they understand, hey, I go to the grocery store. It used to be $100, now it's $150. Like, what the hell's happening? So I
Right.
think a lot of people are starting to wake up and figure out, we need to figure out something to combat this issue. Um, and they don't really know the reason why. I mean, we have I know some people, kind of believe, maybe the media or the narrative or something like that, or believe it's potentially the Putin rate hike or something like that. But I think as soon as this Russian Ukraine war ends, whenever that'll be, if inflation is kind of here to stay, like they've said, they'll kind of realize like, hey, it wasn't all this war. So um, yeah,
Right.
another topic that we, as far as inflation goes, we mentioned it here before, but we both live in Tampa, and I think
Hmm.
Tampa and Texas and a lot of these southern states have kind of seen skyrocketing rent. I think that's kind of a lot of due to the to COVID-19, where Tampa and Florida as a whole, and Texas and a lot of these southern states kind of stayed open, so a lot of people decided to move down, and like we mentioned before, the remote working. People want to live a little bit where it's sunny, maybe a little bit nicer place to live. So what do you think, some of the potential consequences for a city like Tampa are, when we're seeing like, just massive rate or massive rent increase in places like, that are generally speaking desirable to live, like downtown and, in the various bar districts?
Right. So it's such a tough subject because there's so many ways to look at this. I mean, it kind of depends on your viewpoint. Um, Me personally, I think it just more so contributes to urban sprawl in the sense that, a lot of people aren't able to live in South Tampa and downtown Tampa like they used to. I mean, I remember growing up, my grandmother's house was maybe in the 300 to 400 range. I looked on it on Zillow literally last week and now it's like 1.2 million. It's just honestly absurd and kind of shocking because, growing up around here, like I would have never expected that Tampa would be kind of a hub for the younger generation and the people who are trying to, work remotely. I always knew like Miami or Orlando was always a hub because of just the tourism that aspect, but in my wildest dreams I never expected Tampa. So I think it's negative in the sense that it's causing a lot of people and kind of the culture of South Tampa to kind of spread, which isn't necessarily a bad thing, but I think it's losing a lot of its neighborhood culture. I mean, when you look at Tampa, probably about when, for instance, my mom was growing up, I mean, it was heavily Hispanic, Italian culture. Um, Everyone knew everyone, all the families knew each other. I mean, you still get a little bit of sense of that in South Tampa because it's just the nature of how it is, but I think you lose kind of that what made Tampa great is what you're losing because people can't afford to live here anymore. So now they're forced to move, different areas like Seminole Heights, Riverview, and Brandon, which is great for those areas because it's going to start developing areas like that used to be, not the greatest places to live. If you were to tell me, 15 years ago that you were living in North Tampa, I mean that was a pretty dangerous place to live. 15 years ago. Nowadays, you can drive through Seminole Heights and you can go grab breakfast with friends, lunch. It's an up and coming area. So it's just places like that, Riverview, Brandon. A lot of those places were kind of rough and rugged, and now just because of how gentrification works, it's ultimately just blossoming. So it is tough because of the fact that it's, South Tampa is losing its culture, but which I hate. I'm not a fan of this new clout chasing culture that's in Tampa. It's like almost like a mini Miami, but um, I think overall for the greater Tampa Bay area, it's great. It's just it's tough for the specific urban spots. So
Yeah, I mean, I kinda noticed that too when I moved here, I moved here, like, basically at the start of 2019, and so, yeah, it just seemed like it's kind of blown up, I got a job interview down here, and I was like, "Oh, well, the beach, it seems like there's a lot of, young people and places to go," so it seemed nice, but I think, COVID definitely, rapidly increased that growth and everything like that, so, I mean, it's good for the city, but at the same time, I think it also kind of depends on, where the leadership in the city, um, puts the stresses like growth and everything like that. Because, I growing up in Austin, I really do like Austin, Texas, and people go down and visit and they'll love it and things like that. But it's changed a lot, and I think some of the policies that were put in place kind of made downtown not as desirable as it once was when I was growing up there. But it seems like Tampa's kind of doing the right things, at least from what I can tell right now. So I hope that'll continue.
right now they are. I mean, ultimately, it's all about kind of how you allocate your capital resources. Luckily, Tampa's kind of slowed down. I think that if you know Tom Brady were to bring another Super Bowl, I think that would have just pretty much promoted more growth. But I agree. I mean, it's all about the scalability of a city, and if the infrastructure is in place, which luckily I think for the most part Tampa is, we're not as um, consolidated and kind of squeezed together as Orlando. Because I mean, you drive to Orlando now and it's a nightmare. I mean, it's such a big city, but its infrastructure was not built for that. It was only built for really Disney and a tourist attraction, and the inflow of all these residents now. I mean, you can visibly tell just based off traffic and everything. I mean, when you drive from Tampa to Orlando, it used to be just a maybe 50 to hour minute drive. Um, but now, I mean, it takes close to an hour and a half, 2 hours because you're just stuck 30 minutes out driving, an additional hour. So who knows? I hope for the best.
Yeah, I hear you. Well, you mentioned allocating capital, so now we'll talk a little bit about allocating your personal capital. So, do you do any like stock related investing or any other kind of investing? And if so, how do you do it? And I guess what are your some of your goals that you have to, with investing?
Right. So when it comes to allocating my resources, I do it all myself. I would be very upset with myself if I went to school for 5 years in finance and accounting and didn't understand at least the basics of stock trading and just overall investing. So I typically, I have my traditional 401k that I contribute to. I try and max that out as much as possible. Just and again, it kind of it's determined on what your employer matches. If your employer is not really matching, I mean, you don't really need to use a 401k. You could put it in ETFs. It's kind of your risk appetite. And this is just me personally. I'm not giving anyone, stock advice. I would just say that luckily my current employer matches pretty well, so might as well just maximize that if it's free money. So, um, but I typically use a Robinhood account to do all of my investments. And when it comes to goals, I always make a joke to my girlfriend that I invest in this one stock, right? That it's low risk, potentially high reward. And I said, look, if this thing hits $10, we're gonna be good. You'll see it. You'll see a ring sooner rather than later. So, just things like that. I mean, but when it comes to overall just goals, I would say just consistent growth. Trying to match the market of traditionally 7 to 10% is always the goal. But yeah.
Yeah, well, I mean, you mentioned 7 to 10%, which I think is interesting that you brought that up because, I think I was talking to one of my buddies, Dan, who was actually former co-host before he had to leave me here, but he was complaining last year that he only I think he had like only like a 25 or a 30% return because of how inflated the market was, and he thought that he didn't beat the S&P 500 by enough when obviously it's the average is around 7 to 10%, maybe 11 depending on who you ask. So how do you look at your investments? Do you generally just use like ETFs, or do you kind of play? I know you mentioned the one stock to go to $10, but do you kind of just you know pick at companies that are in your, I guess, in your wheelhouse, or do you just mostly ETFs and kind of just throw some at random companies here or there?
Yeah, so if I had to take a certain percentage, I'd say about 80-ish percent, give or take. I mean, it just kind of depends on the day, but usually around like the 60 to 80% is in ETFs. I think that having that safety net of just following the market, because traditionally speaking, I mean, I know your friend Dan hit 25%, but there's definitely going to be a year where he's going to be negative 25%. It's just how the market goes. And if you look at the past 50 years, it's always going to stay at an average of 10%, right? So there's always going to be highs and lows. It's like a roller coaster. There's always going to be good years and bad years. So I think that allocating a certain percentage of your investments to ETFs and the mutual funds, I think is a good practice. And then with that, and again, it kind of depends on your risk appetite, right? So if you're not really feeling risky, I'd say 80 to 20. If you're feeling risky, 60 to 40. That's just my personal preference. That's what I've kind of seen throughout the years that I've invested. And so with that 20 to 40%, I would say I take that money, and the first thing that I look at before I invest in any specific company is their balance sheet and cash flow statements. I know a lot of people look at their P&L and look at the revenue, and they're very top line focused. But I mean, I'll never forget the same professor that told me I needed to move up to one of the financial hubs was like, look, all you need to look at is their balance sheet and cash flow. That'll tell you everything you need to know, because cash is king. And ultimately, you can determine the health of a company or a firm by their cash flow. If they have negative cash flow, probably not doing too good. If they have positive cash flow, they also may not necessarily being too well. You have to kind of balance you analyzing both of those to determine whether or not a certain stock is within your realm of risk. Case example, right? You look at the airline industry during COVID. A lot of them took a massive hit. One company stood out, Southwest. Why is that? Because they had a very strong balance sheet. They weren't heavily leveraged. They had a lot of cash on hand. And so I think it's kind of taking those two financial statements and comparing it, and just overall taking the time to understand what you're investing in. I know a lot of people just go on these momentum investments, which is probably one of the dumbest things you can do, because in my opinion, for every story you hear of someone making $100,000 off of Dogecoin or GameStop or whatever the case may be, there's probably 1,000 other stories of people who've lost more than that. So I think it's all about taking the time and effort, not and realizing it's not instant gratification. You have to put the time in to understand what you're investing in.
Yeah, so it sounds like you kind of have the almost like the Warren Buffett, the value investing kind of principles, which is definitely not super common for people our age. You already mentioned it, with the emergence of Bitcoin, crypto, and like GameStop, and even like just standard tech companies. It seems like everybody's kind of chasing the next bag, so to speak, and like kind of like a get rich quick scheme. So, why do you like, I guess, advise that? Do you think like these growth companies and like, maybe I guess crypto or Bitcoin or anything like that, do you think that they're going to, be hit even harder than maybe some of these value companies that have just a steady cash flow coming in comes a potential recession?
So I don't necessarily think that Bitcoin and crypto are bad. I think that investing a large portion of your potential capital isn't the wisest thing, just because of the volatility of those investments. I mean, by nature, they are very volatile. I mean, we've seen it over the past 5 years. Um, when it came to situations like GameStop and AMC, I think it's terrible for the market. I mean, you ask any investor, anyone in finance, that's like one of the worst things that could have, I think, happened for the market, because it just shows that if you get enough people to influence, it's almost like market manipulation to an extent. Because if you get one person who has a massive following, say like an Elon Musk or Jeff Bezos or whoever, like they can manipulate a stock. Case example, Elon Musk, he was promoting Dogecoin, I think right before he purchased a bunch of it, and he goes on SNL and talks about how great it is. Probably made a great return on it and sold it out. And then what happened? It crashed. So I don't think that those investments are bad per se, because I think there is, to an extent, a wave of the future with Bitcoin and cryptocurrencies. It's just that I don't think it's reached that phase yet. And I think there's just too much volatility. And I know people who use Bitcoin are very much against regulation, but there's a reason why they're against regulation. It's because of the fact that they're able to manipulate the market so much. So I don't think it's necessarily bad. I just compare those situations to the, a Vegas casino, right? You walk through a Vegas casino, you see thousands of people. I guarantee you, for the people, you always walk around and you see people yelling, right? Like, oh, they just won a bunch of money. That's awesome. Well, guess what? I guarantee at that table, like the other four guys lost a shit ton of money. So again, I think it's not necessarily bad, but I wouldn't go and I'd say maybe 5 to 10% is what I would invest in when it comes to Bitcoin. And I know that there's people who are probably going to listen to this and be like, yeah, you're an idiot. Like Bitcoin's the future. I know those people. It's just not my style. Everyone's got their own style.
Yeah, no, I hear you. I'm a Bitcoin guy, so I invested a couple years ago, so I've done pretty well on that. But to your point about other cryptos and things like that, I think when it comes down to it, it's a lot of just similar to your thesis when it comes to investing in companies. Like if you don't really understand it or understand the utility or whatever the meaning behind it, you're going to get rug pulled on some of these risky investments, whether it's GameStop or whatever it is. We actually had Portnoy, the president or founder of Barstool Sports, put out a video today about his Safe Moon investment, which was like just a shit coin that he even claimed he didn't even know anything about. He put 40 grand into it, and he checked the investment, and while he was at the conference, it was at 4K. So he got like basically 40,000 to 4K. And then they said, you need to, I don't know, go to volume 2 or whatever it was. I have no idea. I don't know
Right.
anything about Safe Moon. But and once he switched to volume 2, it went from 4K to $140. So went from 40,000 to 140. So I think I think Bitcoin's here to stay, and a lot of these other ones are not necessarily the greatest investment, but I think everybody's going to kind of do the research and come to that conclusion on their own before, because you're going to have people push things on you, and you're going to think you're full of
Right.
shit. Eventually.
Well, no, I think the wave eventually is going to get there. It's just like you said, the ones like Bitcoin, Litecoin, Ethereum, those are very established. So I think those aren't necessarily risky. It's just these like one-off ones, like you said, that you can put 40 G's in, and then you walk away for 15 minutes, and it's down to 4. So I don't know. I mean, I know it's the wave of the future. I have a little bit of an investment, but nothing like earth-shattering. So I get it.
Yeah, I gotcha. All right, so I guess a little bit more of a difficult question. How do you determine that you're in a bad stock position, and like I guess determine whether or not you're going to sell?
Yeah. So again, I know this is going to be debated till the end of time. For myself, I look at its 50-day moving average. Um, if it crosses below its 200-day moving average, it might signal, kind of a change in its trend. And so again, it's all kind of about your risk appetite. Like if you need the funds like now, once you've taken, probably a 10% hit, maybe it's time to, cut your losses, walk away from the table, say, all right, that was a bad one. But the key is you got to learn from it, right? Like, why was it that you lost 10%? Did you buy during a peak? Um, just things like that to understand. But I'd say, yeah, I mean, it all depends on your risk appetite. Like, for instance, right? Like, one of my stocks is taking an absolute shitter, but I've already put enough money in it that I think like it's not going to hurt me if I leave it in there, and it's not going to hurt me if I take it out. And it's expected to go up. I mean, everyone expects their stocks to go up, but um, again, it's kind of a wants versus needs basis. So what I recommend is, again, if it hits that 10% mark, maybe start evaluating it and saying, why is it going down? Is this kind of a shock, or is this more so like a long-term trend? Because a lot of times, these companies will take a shock, right? Like Ukraine, Russia, that shocked a lot of industries. It spiked all of the gas companies, right? So that's just a current event shock that happens. So I think that's it. I would give it like maybe a 30-day um, analysis and then kind of go from there. But I always say it's better to sell when you're at a loss than a rapid win, because then you don't have to pay taxes. So that's just my viewpoint. I always aim to try invest in companies that I deem a long-term capital gain, not a short-term, because obviously the more you make in a short-term game, the more you're going to have to pay in taxes eventually. The bill always comes due. I know you hear all these stories of people making 100K off of one stock, but in reality they're only making like 60. So that's just kind of my viewpoint on the matter.
Yeah, I got you. Play the long term game. And I think another thing that helps me with it too is, before I invest in a stock or a company or whatever you want to call it, I develop a thesis behind why I invest in it. And, once you have a long term outlook on it, the price necessarily, like maybe you could get it a little bit better of a price or what. But at the end of the day, if you truly believe in the fundamentals of the company and everything like that, the stock theoretically should go up as well. So, I think just having like a long-term outlook helps as well. So, when you play with these short-term games like you're talking about, that's when you can potentially run into trouble, especially if you don't know what you're doing. So, um,
Right.
yeah,
Well, it's also about kind of analyzing, okay, what do you as an individual, right, use on a daily basis? Like, what are your specific needs? It's kind of like what kind of pointing back to Warren Buffett, right? Like, he, for the most part, invests in stocks that he uses on a daily, monthly, yearly basis. I mean, that's why he invested in Delta, because he flies Delta. That's why he invested in Amex, because he uses Amex every day. Like, those are going to be stocks that are going to be around for a long, long time. And unless, some freak accident or freak, event happens, they're going to be continuing in business. So I think, like you said, it's kind of like developing that thesis of, okay, why is this a value stock? How does it bring value to me? How does it bring value to other people? Because that ultimately, at the end of the day, that's what's going to determine the stock price. So,
yeah, I gotcha. All right. So, what are some tools, if any, that you use to analyze stocks and find companies?
so a lot of times I just use Excel. You can go to Edgar, which is kind of the SEC filing website, and you can download any type of SEC file document, whether that's proxies, whether that's press releases, and or quarterly financials, yearly financials. So I usually take those, and then you can kind of convert those PDFs into Excel spreadsheets if you'd like. That's what I do if I want to do any type of analysis, whether it be the return on assets, return on investments, um, things of that nature. So I typically like to look at the ROA and ROE when I do that, just because that kind of gives you a sense of the health of the business. Um, and I think that's ultimately the source of truth, right? Like, those are audited financials. um, you can do all types of like Power BI analysis and all this and all these, pizzazz and look for trends, but I think ultimately the proof is in the pudding. It's going to be in the financials. A lot of times they file, 3-year financials. So on a baseline, I think that's like a good starting point. And then if you want to start comparing it to, other companies within its like peer group, that's when you can kind of start consolidating all of that information and then run your own analysis and say like, hey, you know, I want to invest in this, this, and this. I mean, case in point, I remember I was bored during COVID, and this was obviously during like, a lot of free time. But I took the price of, probably like 20 stocks that were heavily impacted. So, cruise lines, hotel industry, airlines, like different ones that were immediately impacted, right? And I took their stock price based on, let's say 1-1, and I saw their stock price at the current moment. And then I ran that comparison to say, okay, these are very, value stocks. Even though they're taking a hit right now, they're value stocks. It was like Marriott, Delta, you know, companies that the government, for more or less, isn't going to let go out of business. And if you run that analysis of saying, okay, I'm buying right now when it's at a dip, it's a known dip, it's the COVID pandemic, it's everywhere. If I buy right now, if let's say I were to allocate $1,000 on like a price weighted index, where would my return be if I were to get to just the original levels of 1-1 2020? And I think like kind of performing that analysis is something that can be utilized to say, okay, this is a good investment, this is a bad investment, this is the potential return, this is the potential loss that could happen. So again, at the end of the day, investing's like a very structured and regulated version of gambling. So it's kind of a crapshoot. But
Yeah. That's interesting. I didn't realize that you can find out everything on one place on the SEC website. Because usually, how I find a company's financials is I just Google, Apple investor relations or something like that, and they generally have their like media press filings and then all their documents and stuff like that on their
yeah,
investors.
usually companies do have their SEC filings on their company website, at least the publicly traded ones.
Yeah,
Like you said, the Apple. So yeah, typically it's obtainable.
yeah. You can find them. You just got to know, like, I guess, where to look.
Right.
All right. So, last question to wrap up. You've been very generous with your time here, but say one of your friends came up to you now, because it's, they're hurting with inflation or whatever. They're trying to figure out a way to grow their money because they're realizing that just putting it in a savings account with 0.25% or 0.1% is not doing it for them. So, what advice would you give them to get started investing, and how would you help them get started?
Right. So I'll use a anecdote of one of my close friends. For instance, he has been in medical school the past, what is this, 6 years now. Has a huge amount of debt. But he's come to me personally and said, hey man, like I really want to understand finances. I really don't understand what's going on. I've, I've been in med school. I don't have time to really focus on this. Like what kind of like tools of the trade and or secrets do you have? And what I always tell him is, look, I know you're in a lot of debt. So you need to start first off, number one, establish a budget to eventually pay off that debt. Obviously, he's in a profession where he'll pay that off, relatively soon once he's out of his residency. But I also explained to him, the law of compounding returns. It's something that a lot of people don't understand. They hear it, they hear compounding returns, but again, like if you put let's say you put $1,000 right in the market and it grows at 10%, right? The next year, let's say, and this is just an average, the next year it's going to be worth $1,100, right? Then the year after that, and that's just the 1,000 that you initially put in. It's just going to keep compounding. So if you were to put 1,000, and then let's say on top of the 100 that it's going to gain, without even doing anything, you were to put another 1,000 in, it's just going to continuously grow. And so what I recommended to him was, look, have your set amount of cash, what I like to call like an emergency or rainy day fund, handy. So typically, I know the American average is usually 2 to 3 worst month of rent, or like a certain percentage of your paycheck, whatever that may be, whatever's in your kind of risk appetite. Have that set aside for emergencies, whether it be, medical emergencies, loss of job or whatever. But then really try and focus and hone in on, you need to continuously put your money towards that account, whether it be through a financial advisor, whether it be through Robinhood, and you just disperse the amount every month, or every paycheck. And I think that's what people don't understand about becoming financially free, is because, you know, especially nowadays, news cycles are just promoting people to be so dependent on the government and so dependent on these stimulus checks and handouts. And, you know, it's like I told him, I was like, what if I told you, if you put, $10,000 in here right now, by the time you retired and contributed X amount, you'd be a millionaire. Everyone has the capability of becoming a millionaire. They just don't understand that the law of compounding returns is the way to get there. And I know a million doesn't mean a lot in today's society with inflation, as we've discussed, but still, to a lot of people, that means a lot. And I think if people really sat down and took the time to kind of understand that, they'd be more in tune to save the money from going out to eat and putting that $70 to $80 in an investment that within a year could be worth, X amount of money. So that's the one piece of advice that I would give to my friends, who don't understand finance. And I always tell all my friends who are in like medical school, I'm like, look, if you ever want to sit down for an hour or two and just talk about things, I don't want to know anything personal about you. I just want to understand what your ultimate goal is, and I'll tell you what you have to do to get there.
Yeah, and I think you mentioned it with Robinhood, and before would point friends and families to this app called Acorns, which essentially would, you could set it where you can automatically deposit, and it would just invest it for you, and it was like a robo advisor sort of thing. So I mean,
Right.
there's definitely a lot of avenues out there, especially with technology, that have made it easier to get started. So yeah, for anybody that's listening, I think, if you're determined enough, you could just do a couple Google searches or ask a friend, because I'm sure people have friends now that are at least one or so person that's interested in it or has looked into investing in some way, shape, or form. Just talk about it. Just there's free content out there. You can definitely do your own research, and you don't have to be an expert to get started. That's for sure.
Absolutely. Couldn't agree more.
All right, John. Well, thank you so much for your time. And yeah, do you have anything you want to give us, some parting words to sign off here?
No, it's been a great experience. I always love talking about finances, especially in today's hectic world and volatility. So it's always great to kind of discuss that and see where your mind's at, because I know we talk about things offline, but it's always fun to hop on and give whoever's listening any type of advice or perspective that they didn't have before. So I appreciate the time.
Yeah, okay, of course. All right, we'll have you back on eventually. Maybe we'll have we'll tell some crazy stories or something like that, and
Deep
dive into.
dive into the trades. I got some trade stories. We could do a whole podcast on that.
Yeah, for sure. We'll do that next time. All right, that's it for me, and that's it for John. Thank you so much.